All right. Let's bring in Chart Trader, who I believe is most likely one of the more popular traders among the group today, as his trade in the mini Nasdaq is making some listeners out there some money. I assume some money for you as well, Chart. Good morning.
Yes, indeed. Good morning, Jim.
Yeah, so here we are sitting right at the session lows as we bring you on. You took a little bit of profit on this one. You still have about half or so of it, maybe a little more.
Correct.
And I guess well, let me back up, because yesterday, if I recall, in the afternoon, you were thinking about making a trade into today that you were looking to potentially fade a pop in the market, fade anything that any type of strength that we might have saw this morning. However, we didn't get that, and you sold
Right.
into weakness. So walk us through kind of what you were thinking, what got you into shifting gears and going with the flow instead of looking for a fade.
Well, I mean, we didn't get the rally.
Well, yes,
reasonably...
let me. I don't mean to cut you off. I meant I knew that we didn't get the rally, of course, but you didn't decide to wait for a fade or sit on your hands and not do that trade, but you decided to go with it, which is kind of a different mentality, right? You had one hypothesis and you shifted gears and went with another one. So that was really what I was trying to ask.
Yeah, well, it comes down to the fact that I had a reasonably strong directional bias about today, as of yesterday afternoon, that we'd be headed to the downside, and it was just a question of where we petered out the kind of reaction momentum following the drop in uncertainty, the drop in I mean, you've got a lot of plumbing at work there when you get to a major volatility event and you get past it, and oftentimes you'll see a drop in the VIX that can feed back through into a rally into the market, just simply because people are now taking off all their hedges that were just even bidirectional hedges around current price. So you start to drop those hedges out of the equation. It drops the VIX down, and sometimes that feeds into a rally. And I also think that we're right at that point where the question of whether or not the market is going to be up on a year-to-date basis is a little bit in the works. And when you start to rally, you start to put back on people's radar the possibility, we could end up closing 10% up, and if they've hedged away all their exposure, then they kind of are forced to beta chase in. And, I think that's kind of what we saw following the election, which, by the way, dealt no surprises. So it was not a reaction to the surprising outcome of the election. So that's where I look for these sorts of explanations. So it was just a question of where that petered out. And I felt there would be one more squeeze. I felt like there were too many people trying to pound the bid just following the Fed. And, I just felt that they would get it handed to them and get squeezed out, and then we'd roll back over. And we just didn't get that mix of moves. And then this morning, just the feel of the tape, it just seemed like, the attempt to bounce was going to be futile. So I saw a good opportunity in terms of the structure of the pattern around half an hour after the market opened, then it just made sense.
Was it a somewhat of a descending triangle that you were looking at?
A flag.
Yeah. Is that what it was?
Yeah. Just a flag pattern, yeah. I mean, if you just look at, 3-minute Nasdaq chart, it's a pretty clear kind of bear flag that was building there. And you tend to get this kind of, this in any flag, you tend to get this point where you get the highest high in a bear flag, and then you come back down and retest the sloped line of support, which is really the trigger line, and then you get a bounce inside of it, so you make a lower high. It's almost like if you look down on a small enough time frame, you could almost see something like a sort of head and shoulders-y kind of thing, except with a sloped neckline, and it's that other shoulder that I want to short. So
Right.
that's what I shorted, that outside shoulder. But, to me, that's just a flag. It's just got that lower high at the end, and that's, the best flags do. Or in a bull flag, it's got that higher high at the end. So the thing that gets the bounce that comes off of that sloped line of support, where the support is trying to come in, if you think of any flag, it's really just a process of people trying to put support in. There being a bid there, but it just gradually gets eroded away and then caves. And that point where it's just taken too many hits, it's got a last gasp to hold, bounces it back up inside of the context of that previous leg, and that's the short, and you can put the stop right above that previous leg, and it's a very nicely falsifiable little pattern. I use it a lot.
And I noticed you put your stop right at the 7100 level, and
that was just coincidence.
Okay,
it was
well,
just out. It was a couple points above that last tail, and you know, it just kind of worked out. I like a 15-point stop in the Nasdaq right now, and it's just become kind of like I look for patterns that seem to be in the rhythm with that type of risk.
Well, the reason why I brought it up is not because of the round number and that you used it, but I put in a line a few weeks ago when you highlighted the 7100 level. I think we were trading above it, and you were looking at that as a potential target, or I forget what it was, but it became somewhat of an inflection point. And
I think I saw. It might be you were talking about. I think I saw. There was an enormously large bidder sitting at that level.
Yeah, that's right. That's what it was.
And then Gavin got back to me saying that was a good spot because there was somebody in there that was just doing a tanker load, and it was just a question of whether or not they'd have to turn around on that. You know, if it got slipped past them and through their fingers and got stretched far enough away. That's always the danger when you see a really big single order flow. That if it goes the other way against them. You know, we saw something like this. The best example I ever saw was in the flash crash back in 2010. There was obviously there was a rush of somebody really big doing a tremendous amount of size selling, but there was a level that held, and there was a particular bidder that got in there and just did size like I've never seen before when it had already gotten seemingly stretched too far. Somebody making a big play, and when we really went into that Drano move, that if you guys were trading it back then, anybody who was, you remember when it just went from a ridiculously large loss to just a ludicrously large loss. It just went around that corner into just la-la land on the downside. And that turn, I think, is when whoever this big bidder was had gotten so far out of the money that they started to puke it out. And it was the other side of somebody really taking a stand and digging their heels in, thinking that there's no way it can go very much further. And then, I don't know, they get a tap on the shoulder from the risk manager or something, and it's just going the other way. And that's kind of always when I see a single big player in a momentum market moving the other direction, that's kind of, I have that in my mind of, well, if we get stretched down, where's that breaking point where whoever this is filling up is actually turned from being a strong hand to a weak hand. And that's kind of the main thing that I was looking at that day, but it also turned out to be an important point because he kind of more or less held the market. Slipped a little bit past, but then it came back. But yeah, I think that's what you were talking about.
Yeah, well, I kept that line in there, and sometimes I do that and it's amazing how many times these lines will hold up or be some type of key level for whatever reason. I'll have levels that I'll put in crew market that I don't know if I saw it or if it was something you pointed out, whoever. It doesn't matter. And I'll leave it in there for a month or two. It's crazy how these levels trade. Well, the point I was even bringing up is because we have identified it as a key level, and it had been, and highlighted it, a few days ago even. The fact that you had that flag short right below that level, it was only 15 points below that particular level, is, I guess, further evidence, further pressure, more of that lead blanket offer that could definitely kick in and really apply some momentum to the downside. So, with that said, with that out of the way, where is your next target on this one, or what are you looking for from the market dynamics?
I'm not really sure. I'm just kind of trying to let it tell me what it can do, I guess, a little bit. I've got kind of a telescopic view of these things, and I had my initial, I know I'm going to get this 70-50 area, and the question is, is it really going to turn into a trending tape below that, and we're back below the 200-day now in the NQs, and, this is something that could turn into a near retest of the lows or 67.50 or something, and I don't want to be too aggressive if I'm gonna let this thing move around a little bit, but we've got a lot of tape bombs that could come in with the administration. I think starting to my guess is that we are going to start to see a surprising willingness to deal on getting tariffs out. It's just a hunch, and I feel like headlines like that could hit here. So I'm just kind of a little bit worried about holding too much on the short side, but I would love to be short after headlines like that clear, and then the market starts to show me some weakness again. But it's a little bit nerve-wracking to be sitting here on possibly a swing short in an index play when and my reasoning, I don't want to digress too much from your question, but my reasoning is I feel like, and we talked last week or the week before, last week, and I made the point that I thought that China had cost the Republicans the House. It was going to cost the Republicans the House. And the reason for that is I think that the GOP really is two separate parties at this point. And one of those parties is where all the money comes from for campaign funding. And that's the party that hates the tariffs. That's the side of the party that really hates the tariffs. And if we're starting to gear up for campaign fundraising for a presidential election that really is going to start in the middle of next year, and a lot of the fundraising happens, in the 6 months ahead of when you're really trying to kick that off. And yeah, I feel like the apathy that they've sown into that side of the party is a problem for the president right now. So I think it's possible that we could get some surprising movement away from tariffs in coming weeks. And, it makes it a little bit nerve-wracking to sit short. But especially when I just saw that Peter Navarro is going to be speaking, which is one of those moments. Either way, I'm going to let it run, though, and I've got my stop wide. I've already taken some profits out of it. I think that we are in a market that could see another couple hundred points on the downside if I've got the space now to let it work through some things, and I feel like I do, so I'm probably just going to let it kind of work through some things.
Hey, Brett, Gavin here, just jumping in. Just some of the Navarro headlines have crossed. It doesn't seem like he's really backing down at all in the initial one. So I just wanted to give you the heads up since it was pertinent to the conversation.
Thank you very much, Gav.
All right, since we're talking about the Nasdaq, let me address a question that one of the listeners had. I don't know if you've seen it yet, but I understand, I can empathize with the listener because of how quickly these markets move. Now, the question is, how do you handle a call that you would make? So pretend you're not you. You're just
right.
Listening. You're one of somebody following Chart Trader, and by the time they get your call or hear your call, the trade is somewhat out of the money. Now, when I looked at it, it was only, I believe when I announced it, it was probably 3 points away from where you got in. You got in at 70.85, and it was trading like 70.82, something like that. But in the case of where it kind of it moves in the direction right away, and somebody's trying to jump on board, they have this crux of, do I wait for a pullback to his level so that I have my risk appropriated, or do I go with it? I can understand the frustration, especially if you missed it, or if you're waiting on that pullback just for even a couple of ticks. How do you advise a listener to handle a situation like that? Because it does happen, and markets are slippery, and we do have a slight lag by the time that you put on a trade and posted the page, blah, 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 whatever. So how do you... What's your best recommendation to handle such a thing?
I would say if I was in the position of the listener and I trusted the idea, I would say the trades that work out the best generally do move quicker because that side of the market is vulnerable, and we find out about it as it happens. And normally the best trades don't come back to that level. Mm-hmm. Sometimes they do, especially right off the open. If it's within the first 15 minutes or so of the market day, the rules are all different. But once you get past the first half hour or so, if it moves right away, it's more likely to be a good trade, and it's more likely not to come back, and that's just the way it works out. And I would say that the solution to the puzzle is, as long as it hasn't gone significantly far away from my entry, if it's just a few points away, I would take it just at a little bit lower size and keep the stop where I put it. I would chase it, I would take it a smaller size, and put the stop where I put it.
Let's say 10 ticks. What would you do in that case? Because I've seen that case.
10 points?
Yeah, 10 points. 10 points. Okay. I'm sorry. So if it's 70-75, let's say.
That's a tough one. I don't know if I would take that, because at that point what you're talking about is you're risking 25, and if I'm risking 15, you know that so just as a general rule of thumb, if I don't think I can get twice risk, I don't put it on. So you can assume that my minimum assumption on a 15-point risk is I'm going to make 30 points into the money. So you're risking 25 to make 30. That's not a good risk reward at that point. If you're risking, that's really right on that line.
I know. That's why I asked it.
Yeah, I know. You got to. I would say it's you're just. It's not going to be perfect. There's nothing I can tell you that's a magic answer to that question. You're going to have to use your judgment. If I feel like, because the alternative is I don't post those trades. If it seems to me like it's a fast-moving market and I'm not sure that I can give you a good entry, then I won't post it. But that's a worse situation. And I'm sure that most people would agree that would be a worse situation. So you're going to have to use your own judgment to some extent. And I would say if it is probably 10 points is a little bit far in the Nasdaq right now, given the risk that I'm taking, because you're getting close to doubling my risk at that point to get your stop at the same point. Mm-hmm. But if it's inside of that, I would just take it on a little bit smaller size and keep the risk at the same point. The main thing would be to keep the initial stop at the same point I do without risking more money than I'm risking. So the only way to do that is reduce your size. And the reason I say that is because the main setup point to me, the reason why I take the setup is because rule number one for me is where the point of falsifiability is on the trade. So if you put your stop inside of that, then it doesn't make sense. The setup isn't the same setup. The point of the setup is it shouldn't get back to this price or else I'm wrong about my bias. Mm-hmm. That's why it's a trade. That's why it's a good trade. I've got a strong conviction bias, and I understand what would falsify that bias. And when I see a risk reward that makes sense, given that construction of concepts, then it makes sense as a setup. So if you take it 10 points in the money but use a 15-point stop, then your stop's only 5 points on the other side of my entry, then it's an entirely different setup. And then you may well sit there watching me make money after you've taken a loss. So I would say smaller size and wider risk would be the solution. But, if it moves too far, then the risk reward no longer makes sense. So, also be willing to just say, okay, I didn't catch this one. There's going to be ones that I catch. Some of the ones I post sit around my entry point for 10 minutes and then take off. Mm-hmm. It's hardly every trade that moves as quickly as this morning's did. I happened to catch it right on that shoulder of the flag that we talked about, and 2 minutes later it was, 7 or 8 points in the money. And it never was out of the money, even for a split second, which is a great trade. That's a great situation, and it means that side of the market was vulnerable. And we're seeing that play out right now, big time, as I'm sitting 70 points in the money. But it's a testament to the fact that I was right about that setup, that it moved as quickly as it did. So, I guess it's just a scramble. And I think a lot of these situations really pay off for people who are looking at the same idea when they see my trade come across. That's probably when it's best, is that I've already talked about shorting the market today, and maybe you agree with that idea. You've done your own research, you've got your own bias, and you see the same basic idea, and you're sitting there trying to time the entry, and then you see my trade come across. It's usually pretty easy to get just about my price. If you're looking at something else completely, and you don't have the NQs up on your radar, and you've got to go through a number of steps of processing, and it happens to be a fast-moving trade, there's a decent chance that you should just let it go. But there's no perfect answer to that question, and I wish there was.
Yeah, well, I would venture to, I'll play the role of the trader who might follow. It's really a problem if you're only trading a one lot. If you're trading anything larger, if you can scale 2 lots even on a case like that, if you're okay with that risk, then it really is the same. If say you're a 2-lot trader in this and it was a 10-point, well, you can still participate in that and just say, okay, I'm gonna look for a larger piece, because you rarely are one to just say I'm going for 10 points, 10, 15 points, and that's it. Like you said, you're looking for that double risk reward. So just, if you are only going to take half of it, if you're selling it in the hole already, it's already moved in your favor, and you're trying to chase it and you want to participate, do it with that half, with the assumption that, hey, my risk is going to be maybe chart trader second, not where you scalp the first time, but the second level that you do. Because a lot of times I've noticed with yours, you're pretty dead on getting that to that second one. It's the
Yeah.
the coin flip is that next
The big
piece.
target.
Yes, the big target.
And that's exactly how I set it up. You're exactly right.
Yeah, and if you are a smaller trader, taking those and building your account helps you set up for being in a position to take the bigger trade with bigger size a couple months down the road, however long it takes you to build up your account. So that's how I would do it if I was following it. So long as you're not doing a one lot. If you do a one lot and it's 10 points in, you're kind of stuck. Hey, wait, hopefully you can get on the next one and play it accordingly. But that's how I would do it. Scale back into the appropriate risk parameter. Make sure the dollar amount loss that you're comfortable with is the same, whether it's 5 lot or 10 lot that you're scaling back to, whatever. But that's how I would do it, so for what it's worth.
Sounds good to me.
All right. So, let's see. What other markets are really catching your attention post the elections?
Well, let's dive into oil a little bit because that's obviously doing quite a bit now.
Oh, finally we're going to talk oil.
I've
been bugging you for weeks.
That's okay. Now it's worth looking at. So I think that one of the things that I follow and I've posted on a few times over the last few weeks is crack spreads. And I don't know if you've noticed me post on those, but
yeah, a couple of times for sure.
Situation. I think that is really the driver right now. And I don't really. It's a mystery to me why this is the case, and I haven't really seen anybody who's really figured out why it would be the case that we saw such an overproduction of gasoline over the last 3 months, which is apparently the issue. And the essentially, if I had to guess, I would say that it has to do with an interesting failure for gasoline end demand to keep up with other economic indicators as we've gotten to that zone of primary impact, second derivative primary impact, where the fiscal stimulus is concerned. Because everything else has really been popping over the last few months, and gasoline end demand hasn't followed. And I would imagine that if you're refiners or if you're selling to refiners, that your basic assumption is that that's going to come through, that you're going to see typical relationship with primary economic indicators in terms of gasoline demand, and so they've overproduced with that assumption. And now there's a little bit of a glut built up in gasoline, even though not oil. It's also possible that it had to do with assumptions about hurricane interference, because the previous year we had big interference with refineries in terms of hurricanes, and so we had a crack spread that went all over the place. But the principal issue right now is that the crack spread is hammering down the price of crude oil. If you want to follow at home and you have futures data, you can come up with a real-time synthetic version of the crack spread by taking the RBOB gasoline futures price and multiplying it times 42 and then subtracting the price of a barrel of crude oil from that. And you can program that into a lot of different chart interfaces, because there's 42 gallons in a barrel of oil. So you get basically the price of a barrel of gasoline minus the price of a barrel of oil. It's not perfect because a single barrel of oil doesn't refine into a single barrel of gasoline, but you get a basic idea of what's happening, and you can see the chart for that. The difference between the two, obviously, a barrel of gasoline should be worth more than a barrel of oil, or there wouldn't be any refiners. So that's their profit margin, is the difference between those two prices, and it's been going down, 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 down. So that suggests that crude oil demand will start to drop off, because refineries will start to ask for less crude oil because they're seeing less profitability in doing it, because they've already built up too much gasoline relative to end demand. So crude oil is going down in anticipation of this. And I think that this is also something that has a little bit to do, well, a separate issue entirely, I guess, is the Russians deciding that they're going to sell Iranian oil from their own depot. So we've got the sanctions. There was a lot of speculative energy built into crude oil on the basis of the Iranian supply being dropped out of everything. And now if the Russians are saying they're going to take oil from Iran and then sell it, we'd have to put sanctions against Russia. And we're not going to do that. So there's a watering down of the hit from the Iranian sanctions at the same time as we're seeing this compression in crack spreads. So we're diving in oil as a result, and we're getting down to the point where I think the the level of support that I would love to see to start buying oil would be around 57.50 in WTI. We're at around 60 now. And the justification for that is roughly the statistical mode of where U.S. shale players can turn a profit after subtracting all in costs. And we saw that level at around 58 or so put a bottom in oil in February. And I'd like to see a blowout of stops just under that February low. And I think we've got support right in there from the notion that you'd be taking shale, because shale has turned into a switch on, switch off kind of situation now. And if you start to switch off that supply source, then the market's going to start to discount less coming from the U.S. So I think that probably that's a good area to look at. If it finds support at 60, I'll just let it go without me. If we get a peak day down to 57.50, I will probably be involved.
All right. We do have the CFTC data. Any trends that you've noticed that you might be keeping an eye out for? That data is released later today. Maybe something in crude oil might catch your attention if we saw any type of shifts in of the positioning, right?
I'm sorry, say that one more time?
If there's any shifts in any of the positioning, is there any trends that you're seeing, particularly in oil, that may catch your attention, that may help out for next week?
Commitment of traders?
Yes.
Yeah, I mean, we haven't seen enough. Like, it's not. I suppose if we saw a big dive in this week's data in speculative long positioning, I think large specs are still pretty big, which is, kind of keeps you out a little bit from doing too much scale in buying in oil, because they haven't really capitulated. We were at far lower levels of speculative long interest on a contract basis for most of the period from 2014 to late last year, and we kind of entered a new zone of spec long interest there, and we've kind of stayed in that zone. We've peeled out a little bit. I suppose if this week's data showed a significant drop, then that would take us into that prior zone and would probably add that as a factor on the long side.
All right. Well, I mean, that, to me, that sounds like it could set up for that capitulation moment that you're talking about.
That would be a great combination. Yeah.
Yeah. So based on the actual positioning that you're seeing, that if they are indeed still that much long, then that could be in the cards, and you may get that set up. So yeah, it definitely bodes well for that. So keep that on the radar, especially for next week as we head into the next round of crude inventory data. That seems to be the type of day that you could get that real big shift lower and then a rebound.
Yeah.
Of course, that'll be the day after they take the next round of positioning stats.
Yeah, exactly right.
Because they take it on Tuesday, and then they have the EIA data on Wednesday.
Terrible lag in there.
Yeah. So.
Well, that's the point of inference, though. There'd be no point in having inferences if they just gave everybody the data.
Yeah. Well, for sure.
There's a way to have an edge.
Yeah. There you go. All right. So, any other markets that are really catching your attention? What about the bond market? Things still, Italy still having some problems.
Yeah, that's going to escalate. So if you look at the bond market now, I kind of tied into currencies together. Again, I think the big theme we've talked about a lot with Democrats taking the House is essentially cutting off the fiscal stimulus channel, because I just don't think that they're going to allow a Republican-led executive branch and Senate really use government resources to try to artificially fuel an extra leg of a boom right into the presidential election in 2020. I think that is going to be a significant priority for the House to make sure that does not happen. And that doesn't necessarily mean they're trying to hurt people. It just means, they can easily rationalize that as that it's in the long-term best interest of the country to not use a lot of fiscal stimulus at a point, especially when they've got easy tools for that argument. When you look at what deficits are going to be next year, necessarily you can come up with some way to frame any fiscal stimulus as being anything but deficit neutral. So just looking at that basic calculus, I think that it takes off the table. If the converse is important. If the Republicans had kept the House, they would want to do the exact opposite, right? They would want to find new fiscal stimulus plans to be able to boost the stock market and the economy up into the primary period of campaigning for the next election, so that's a major campaign point. And with the Democrats in the House, I think that they can pretty much cut off that from possibly happening. Shifting from that reality, from one reality to the other, probably means that. And one of the most interesting things, actually, that I've seen in the last couple of days is no change really. In fact, a slight increase in the odds of 2 hikes next year from the Fed. And I suppose that's out of yesterday's communication, but it seems like that's what I'm shorting in my mind, is the idea that there'll be 2 hikes next year. Principally because if you take the fiscal stimulus channel off the table, I think that's the pressure maker for the Fed, is doing things like massive widespread deregulation, economically stimulative deregulation, and doing corporate tax cuts. Those are things that are likely to heat up the economy, and the Fed has, in a sense, been fighting against that force. If you look at other major developed world economies around the world over the last 6 months, they haven't had that force, and they've had a very different path as far as policy is concerned. So if you take that path away in the United States, you should see less pressure on the Fed, and you should see maybe both of those hikes for next year start to come out of the Fed fund futures, but we haven't seen it. And that should be dollar bearish if the dollar is just simply working off of that calculus. So I don't see that happening right now, but the dollar appears to be, to some extent, working off of the calculus that we've got things in Italy deteriorating further, and we have a little bit of scramble for cash here in the U.S. So I would say that the shift politically should be dollar negative, and it possibly should be, when that starts to happen, a reason for me to cover my bond short. But I haven't done that yet because it hasn't seemed to be prompting me too much.
All right. Any interest in getting involved in or playing around in any of the European bonds, boons, or anything like that? I know you haven't done it much.
Yeah, it's unlikely.
Okay. Yeah, I can't remember. Last time I traded them, they weren't very, the liquidity in them wasn't very thick. They used to be really good back
It would be very good if after the stuff hits the fan would be when I think I'd be compelled in that direction, simply because we just have enormous volatility and volume and emotion in that tape. So after we get to the point where as I said, I think we're going to eventually get to a point where stuff starts hitting a fan, one fan or the other. When I think that this is not going to be an amicable resolution of what's going on in Italy. I think that it will intensify from here. And so when we start getting credible exit threats and we start seeing the CDS market blow out, then I think that it would be significantly more interesting than it is now.
All right. So outside of that, anything specifically in currencies, maybe the euro or anything that you're going to be looking at?
Well, I should be short the euro right now. And it gave me the move that I wanted. And I got, it's been a tough week for me because in the last month or so I've been sick twice. I got really sick again in the middle of this week, and I have no idea why, and I'm just kind of coming out of that. But the euro really gave me the move I was looking for last time we talked, a bounce above 115. And I should be short that right now with a stop above the 50-day. And it's pretty easy setup. And I just didn't have the focus or have it in front of me when it was doing that. I should have had an alert set, and I should have been more organized about that, because that looks like a very promising trade right now. To be sitting short the euros right now from 1.1510 with a stop at 1.16 would be a fantastic position to be in. So it's unfortunate.
All right. Has gold perked your interest at all?
No.
Nah.
I mean, we're rolling back over pretty hard today here with the dollar strong. I guess if it starts to hold up better against that type of catalyst after getting down to this area, but I mean, we're back under 1210 now. We're back under that treasure chest that we talked about before, and it really got kind of lead blanketed along for a couple weeks and rolled over. So
yeah, well, we're back in that zone. I I think if I remember, when you got long several weeks ago in gold, it was like 1206 or so.
1206, yeah.
Yep, and that level it was almost the low of the day today. It looks like the low is 0720, so 120720. So it came down and tested right back
but
there.
It's already, in a sense,
I know that trade's played out, but it's kind of along the same lines.
Thing. The thing was that it gets to 1240, and then it just, whether the dollar's strong or weak, it just starts to trend higher. It shows me some organic, underlying bullish energy to it, and just starts to move, and people are sitting there going, why has gold been so strong in the last few weeks? And it's, up around 1275 at this point and steaming higher, and it just didn't happen. It's kind of fizzled out.
Brett and Jim, sorry to interrupt you guys. I'm just trying to help you out a little bit, Brett. We're getting a little bit of a bounce. There's a headline coming across from CNBC that Trump's contemplating replacing Wilbur Ross. Now, I don't know why the market would react favorably, per se, to that. Obviously, he's certainly been a trade hawk.
Well, who's Linda McMahon, do you know?
Linda McMahon? Yeah, Vince McMahon's wife. She is the, I forget her exact position right now. Don't know her stance at all. Navarro is definitely the one that's a little bit more hawkish, obviously, but certainly Wilbur Ross has been certainly pressing, a tougher stance on trade, I feel. So I just wanted to give you the heads up because I know you're looking for that. We are getting a small bounce here in the markets. But
oh my gosh, she's the former head of the World Wrestling Entertainment Company.
Yeah. So
that's getting down to the base, eh?
But she also, her current position is, I want to say she's the small business manager.
SBA administrator.
Yeah, exactly. So anyway, I just wanted to give you the heads up because I know you're looking for those headlines. So sorry to interrupt. I'll jump back out.
No, that's really interesting. Thank you, Gav.
All right. Well, does that do anything to your position? Tighten a stop? Anything?
I don't know.
Yeah, these are really tough to navigate through these headlines.
What do I do with that one? I mean, Wilbur Ross was obviously, he has a philosophy about economics that I don't agree with particularly. So it's interesting to see the shift. I mean, again, I've told you my thoughts on the importance of trade deficits and their lack of it. But I don't know what her views are, and I guess it's going to be interesting.
Yeah, I didn't even.
I don't know. I'm gonna take a moment to just kind of gel with this and see if it matters to me.
All right.
There's another person up for it, Ray Washburn, too. Just going through this article. If I find anything interesting, Brett, I'll just hit you on the side rather than keep interrupting you guys. I apologize.
Okay.
Was he the former commissioner of the XFL?
He hate me. He hate me in the XFL.
Yeah, that's great. All right. So, it sounds like you are, recovering from your illnesses and getting back in the swing of things. Yeah, I mean, you either that or you're like my daughter trying to get out of taking a test and ducking me.
Yeah. Well, but you just gave me the test, so.
Well, yeah. Well, I gotta. When I get you, I only get you like once a week or so. So when I do, I gotta give you the tough questions.
Got it.
So, all right. Unless you have anything else, I do have one more. Okay. Chart book. Where is it?
Chart book is under construction at the moment.
Yeah.
And it's good. I'm glad that this is good timing actually to have kind of gotten delayed on that a little bit because it allows me to get a little more perspective because there is a lot of stuff going on, and I wouldn't want to rush it out, especially in a state of befuddlement from cold medicine. So it'll probably be hitting Monday morning.
Okay.
We'll have good perspective on the moves that have happened in reaction to the election results, which will give us a little bit more perspective, give me more perspective, and hopefully, create more value there.
All right. Well, we'll be looking forward to that. We still got the VIX around 18, so we'll probably...
looking good.
Yeah, so even though...
That's our downside. It's beautiful.
I hope so.
Brave new world.
I hope that's the case, and because that sets up for a lot of good equity trades for us in the future. So, all right, Brett. Well, I will let you get off the horn, and you can go digest the newest round of headlines that we've had, and we will look forward to talking about your chart book next week.
You got it.
All right. Thank you as always, Brett.